Good morning, everyone, and thank you very much for joining me today. This is the morning market review, and it is Tuesday, it's the 28th of November. My name is Russell Sherman, Senior Market Specialist at FXCM, and my email address is rshore@fxcm.com. Just going to go ahead and bring up our disclaimers. We're going to start with a high-risk investment warning. We'll keep that on screen for a few moments. Good morning, Kim and Raj. Pleasure to have you on the webinar as always. Just want to double check. Can you guys hear me loud and clear? Good morning, James. Nice to have you on the webinar. Okay, great. Just going to keep this high risk investment warning on for a few moments more. Yeah, there's something wrong with the camera. I clicked the camera and it's just there's some sort of message that's coming up. So just for today, we'll keep the camera off. Beg your pardon there, Raj. All right, let's just go ahead and bring up the market commentaries disclaimer. Hey, Howard. Good morning to you and welcome back. All right, here is our references, MarketScope 2.0 and TradingView.com. Let's go through to TradingView.com. It's quite interesting. Dare I say, perhaps a little tricky. What we've got here is the real rate, the top chart. We have seen that there's this head and shoulders. It hasn't really completed, not to my satisfaction. In fact, we're getting a sideways movement. You can see by this green horizontal trend line, suggesting that the right shoulder, hasn't broken through the neckline. By and large, we've got the US dollar underneath. You can see the US dollar has charted that lower peak followed the lower trough. And then I've got the correlation between the two. We've still got a strong correlation coefficient, but what's happened here is that the real rates hit this support level, which is round about sort of the 2.01. Is that right? 2.01 and yeah, 2.08. It's 2.0. Sorry, 2.1. I'm losing my mind. 2.1. Okay, so you've got this support around about the 2.1%. And what's happened is that price has actually bounced off of this support level just over the last 4 days. Yesterday, it did come back in the US session, but it gapped up and then came back. So when I looked at it yesterday, there was this big sort of movement up here. But you've got the US dollar carrying on going down. So there's almost a divergence between what's happening with the real rate now and the US dollar, the real rate jumping up, US dollar coming down. And I just think we need to watch that because the correlation coefficient suggests that they should be moving in a similar direction, not diverging from one another. So the fact that they are diverging, I think maybe suggests that there's a floor under the US dollar. And there's an article I put on our website yesterday just saying that there could be this this floor underneath, and you can see US dollar flicking up slightly. I think that if the real rate and the US dollar converge as opposed to diverge, then it would be easier in terms of an analytical point of view. But the divergence here seems to suggest to me that we probably have some sort of floor below us with regards to the US dollar, unless we start seeing the real rate coming down again. Interestingly, it did come down quite significantly after it gapped up. and then there's a bit of red. But the fact is, if you take a look at the 22nd of November, which is the blue dashed line up, there has been some sort of divergence. You've got this guy moving up. Let's make this red. You've got the real rate moving up, and you've got the US dollar coming down. See that? So not too comfortable, because I think that should be convergence. They should be moving in the same direction, not divergence. And in fact, what that convergence has done is it's pulled the correlation down slightly, but nevertheless, it's still strong. It's still robust, 6%. I think as soon as we start seeing the real rate starting to challenge this support level again, that would seep into the movement in the US dollar. The obvious worry here is that we don't break below this support level. That's a worry. Why is that a worry? Because if we start moving sort of lateral fashion, and we start moving from left to right, and effectively sort of showing some sort of congestion, I think that reflects in dollar. Okay, and that's what we said before. It kind of reflects. If we start seeing that is going to be a much more difficult place for us to be as traders, because we want to trade trends. We don't want to trade congestion, just because the trends are the easier to trade. Let's show you what I mean, and for that we'll go through to market scope. I want to just bring up the US dollar here. And all right, let's just take a look at US dollar here. It is showing signs of breakdown. We've got the US dollar trading beneath that 30-week exponential moving average, and the 30-week exponential moving average rolling over. Okay, that's at 0.1. And then if you take a look at the RSI is below 50, which is the negative side, and it's just breaking below this trend line here. So at number 2, so it does show some sort of weakness. However, I want to just reiterate that we would like to see the real rate break below the support, so that there's some fundamental force, some fundamental reason that is pushing dollar lower. Now, if we do see compliance, we do see cooperation by the real rate, take a look at what happens with the trend. So what we put last time, okay, we've been looking at the daily, we've been looking at this lower peak, lower trough, lower peak, lower trough. The last time you and I spoke, we were only over here, lower peak, okay, and I put LP question mark and suggested, well, we're probably going to see another leg lower. Well, we did. So we can take out the question mark. We did get that lower peak in. So you can see when there's compliance, it generally becomes more constructive in terms of planning our trades. You've got your RSI here below 50. Now, what I think may happen if we carry on seeing a higher real yield, we get support here. Now, there's going to be some interesting data out this week. We're going to get a fortune of Fed speakers on Friday. Jerome Powell speaking. That in itself is going to be, I think, leading the real rate. If they talk rates higher, if they continually talk higher for longer, we may see that real rate push up. And if we see that real rate push up, then you're going to get the US dollar, I think, showing some signs of support. Because we're in zone 3 here, it would be logical for us to look for resistance areas to see if resistance areas are going to show some sort of compliance. I think that it's going to be quite difficult this week to do that. Why is it going to be difficult this week to do that? Because we've got the divergence here. Okay, I want to see the convergence, not the divergence. If we get that convergence back, in other words, moving in the same direction, I think it becomes much easier for us because we've generally been taking the lead off of the real rate, right? Nevertheless, what we can do is still keep an eye on the zone as long as we're in zone 3, which is the lower blue, the lower red. We would be within our rights to keep an eye on resistance levels. So central pivot, R1 level are levels for us to keep an eye on. I don't want to predict here, especially now that we've got the divergence between the real rate. So we've got to keep an eye on the indicators and react to the indicators. Incidentally, just to kind of point out here, the action happens at the extremes on the actions happen on the extremes of the stochastic. So here you can see that the stochastic hung out in the lower quintile. There's the action. There's the swing. Okay. So the idea here is we've started to move out of the lower quintile. I think that the R1 level here is clearly something that we can keep an eye on. There has been reactions here previously. There's been a reaction here. Okay, let's just clean this up. Okay, so you can see there was a reaction here. There's a whole lot of price support turned resistance here. So I think the R1 level would be an area for us to keep an eye on. Again, I do think this week, as per the reading on the real rate for the dollar, makes it a little bit more tricky for us. I want to just reiterate, it's been the central theme of this morning's webinar. We want to see those starting to cooperate with each other. Okay, so let's just keep an eye on that R1 level. The triggers would have to be pulled. So we would want to see the EMAs push down. We'd want to see the stochastic push down as well. Another reason why I think the real rate is kind of throwing us off somewhat. If we go down to the S&P 500, let's just bring up the S&P 500 here. Okay. We've got this overbought condition on the daily. So effectively, I think what happens is that there needs to be some sort of normalization here. In other words, the RSI pulls back into the below 80 level. If you take a look at the hour, it looks as if that's starting to happen. Well, I think that's an effect of the real rate moving up. Okay, if the real rate moves up, it does tend to act as a headwind for the risk market. The risk market being overbought, we get that pullback. But okay, I think that any pullback here on the S&P 500, we look for the support areas, and then we can see if we can get in sort of a dip in an uptrend type of scenario, because you can see on the weekly chart, we are nicely above the 30-week exponential moving average. The 30-week exponential moving average has turned up nicely. The RSI beautifully above 50. You go down to the daily chart, we are in zone 1. We have lost length on the candlesticks. that makes sense because of the Thanksgiving long weekend. It took some of the liquidity out. But I think if we can get a little bit more sort of movement, we can see if we can get in on the upside. Okay. And what we can do is we can look at the support levels underneath us. So S1 is a level that we can certainly keep an eye on. Take a look at this. Okay, so you've got a level here that the market certainly has kept an eye on. There's been a reaction there. 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 So S1 certainly a level that the market is keeping an eye on. It's around about the 4540 level. Again, given just the fact that the real rates crept up slightly, I want to reiterate, don't make the predictions, work on the reactions, make sure that the EMA bounces off of this, make sure that the stochastic pushes up. Even if we get the triggers pulled, it doesn't really happen until we move into the upper quintile. Okay, so again, I know I'm starting to sound like a record. Just want to see the convergence. Okay. I think that makes our whole analysis much easier. Let's take a look at gold. I do think gold is looking interesting. We did talk about adding this to the watch list. Let's just go through to gold. Gold is now over $2,000 per ounce, per troy ounce. And what we got here is we've got a trough, we've got a peak, okay, we've got a higher trough, and now what we can actually do is we can put in the higher peak. So we've actually got an uptrend here on the weekly chart, and that's just from this week's movement, and that was kind of telegraphed. How was it telegraphed? Well, we had price taking out the 30-week exponential moving average, the 30-week exponential moving turning up, and then the RSI moving above 50 and breaking this trend line. So there was some suggestion of higher gold prices. I think that the fact we've got this higher peak in here, potentially we could kind of see something like this. Okay, something like that. That red line is the 2000. That's the all-important 2000 psychological level. Let's take a look at this on the daily chart, and you can see that there is a squeeze on the Bollinger Bands. You can see that gold is sitting nicely in zone 1. Okay, that means that we can keep an eye on the underlying support levels, right? So support 1, and here's support 2. Okay, so we can keep an eye on those levels. Again, look at the stochastic. As long as the stochastic maintains over here, okay, as long as it maintains over here, we will have the swing. See? So now that we've got the pullback, again, what we want to do is we want to wait for the EMAs to cross up and the stochastic to cross up as well. Okay, let's take a look at one more chart and then we'll call it a morning, and that would be the DAX. So we just go through to DAX. And if we take a look at DAX on the weekly chart, nicely above that 30-week exponential moving average. The 30-week exponential moving average having turned up, the RSI above 50. Go down to the Go down to the daily. Now we've got a very similar type of structure here to the S&P 500 in that the DAX was overbought. It's looking to normalize now. That's refreshing. The fact that the DAX is normalizing, SPX looks like it was normalizing. We can start look at those underlying support areas. Now, again, don't predict here, okay? We want to see the EMA's cross. We want to see the stochastic cross. We don't want to see the stochastic stay here because that would be pushing the pressure to the downside. We want to see the stochastic make its way over here. Then we've got a potential dip in an uptrend scenario, and that's effectively what we're looking for on the webinar, isn't it? Just want to remind everyone what we look for here. So I'm just bringing up Microsoft Paint. We want to identify the trend. Trends don't move in a straight line, they zigzag. So get the overall trend, and then the idea is to catch the dips. Catch the dips. Look for the next dip over here. Okay, and that would be the same for the flip side, except there we're not looking for the dips in the uptrend, we're looking for the rallies in the downtrend. So that's what we're looking for. All right, if there's any questions, please go ahead and type those in. Any questions? Go ahead and type those in. All right, let us wrap up here. Nothing coming through. Tomorrow we'll do an extra webinar. We'll do the morning market review, and we will do the crypto minute. Thanks very much, guys. Have a great day ahead. Cheers.